Let's talk about one of the most exciting and advantageous uses of reverse mortgages. It's called the line of credit. Even though your cash flow and your investments may be just fine and you have plenty of money for now, 20 to 30 years of retirement is a very long time. You may find that it's very prudent to ensure that a portion of your home equity and an essential part of your nest egg is readily available in cash without having to sell your home or try to go out and get a mortgage at a difficult time or during an emergency. Your financial advisor has probably already encouraged you to have a line of credit for unexpected or planned purchases or shortfalls in cash flow that might have been fine back in your 20s or your 30s or even your 40s and 50s. But it's a little bit dangerous when it comes to your retirement years, because when you take money out, you have to pay it back. Those lines of credits, known as a HELOC, can be canceled at any time, depending on what's going on with the economy or your own personal situation. A HECM reverse mortgage has a clear-cut advantage over those traditional credit lines that you've known about in the past, because it has a growth feature and it cannot be canceled unless you don't pay your taxes on time. So it's always available, and the unused funds in your credit line are guaranteed to grow, regardless of what's going on with the general economy. So if you take out a HECM at age 62 instead of 82, and you leave the funds to grow instead of using them, it's possible that that credit line could grow to be even higher than the value of your home, especially in areas of the country where home values don't increase substantially. In fact, you could potentially have a substantial credit line available to you in later years when you may need it the most. You can draw out that home equity and still live in your home by only paying your necessary home expenses, such as taxes and insurance and home maintenance. This is an example of kind of having your cake and eating it too. This is important in our family too. For my mother-in-law, long-term care was her biggest concern. She wanted to stay in her home and never go to a hospital or a nursing home. So that line of credit is her long-term care fund. It's comforting to have that line of credit that she can pull from and know she's got for future use, such as long-term care. It's totally okay if you don't need the money right now. In fact, you might be able to use it for fun things and hopefully not bad things like health problems, but that's the whole point of having an available line of credit. You can practically use the credit line as a standby resource for any future needs. Maybe you want to bridge the Medicare gap from 62 to 65 when you don't have health insurance, or to pay for life insurance or long-term care insurance. So I get it. I've dealt with many families and everyone has a different situation, different challenges, different dreams, different desires. In fact, you may think, well, this really isn't for me. This is for somebody else. Well, if you think that, I would encourage you to call me and set up a time to meet so we can go over your home equity and see how much housing wealth you have and talk about options that you may not have considered. Don't neglect this opportunity. It might make a huge difference, not only for your retirement, but for the legacy of your family.